Hello, everyone. Well, hello, startups. I'm letting everyone in meanwhile, because out of the respect to the ones who are the most punctual ones, we are letting everyone in the room. Today we have a really exciting, and I think that it's worth even moving. It was worth even moving the workshop from one week to the other one due to urgent business trip of the partners of Constructor Capital. We have almost the full squad here, as you see on the slide, and really happy to present to you the Constructor Capital, some of the Constructor Capital team members. We will speak about fundraising, and also, I just want to say that I see that most of you has renamed yourself into the startup name and your name. But please, also, in case you haven't done it yet, you have still some time to do so. Welcome on board. The questions you can ask in the chat or with raising your hand. Meanwhile, so that we will kind of make it more of an interactive session. And if possible, also turn on your camera so that we can see your faces and see how you're reacting to any information given, and probably giving also some comments or clarifications. All right, with this being said, I am giving the floor to passing the baton to Matthias, Marie, and Aram here. And yeah, welcome, dear Constructor Capital team, to our workshop.
Thank you, Irina. So welcome, guys. I don't really see you on the camera, but please chip in. I mean, we want to make this as interactive as we can. But would be good if we can see some videos from you. So basically, the three of us work with Constructor Capital, which is an early stage VC fund. We wanted to provide you a bit of an opportunity to understand how funds invest in your companies, your startups. Obviously, this is different from angel investors. Typically, you would probably start as a company with some angel investors, and then only in a second stage talk with a fund. But it's already important, I think, for you to understand, how the fund works. Maybe go back to one page. Just let's do a super quick introduction to the three of us. So I'm the managing partner of Constructor Capital. See the logo of McKinsey below that. I was working for the firm for 26 years and was leading the TMT practice. And Marie and Aram, please introduce yourselves, and then we get into
Nice to meet you all. I'm Marie Lepsky. I'm general partner at Constructor Capital, and I'm more focusing on deep tech area inside the fund. Previously, I worked at Runa Capital and also had my own startup.
Yeah, my name is Aram, and I'm a senior associate at Constructor Capital, which means I'm responsible for whole value chain of deals. I mean, from finding opportunity till the final closing. And before Constructor Capital, I worked as a head of strategy in biggest Central Eastern European e-commerce player called Ozon. And also I was VP of corporate venture arm of one of the biggest actually metals and mining companies in the world. Yeah. Now
cool.
we can go
Good.
further.
And Aram is one of our most experienced associates, and if you ever send a pitch deck, he will be the first one to receive it. So how does a VC? So as I said, we talked today about VC, not angel investors. Okay. So how does a VC fund work? First of all, VC fund basically consists out of two groups of partners. One group is called general partners. These are people who take the decisions on behalf of the fund. They decide which companies to invest in, when to divest. They will provide coaching, board memberships, etc. So they are the active ones who actually handle the investments. It's one group. Second group is limited partners. These are the people who provide the money. Okay. And typically limited partners have you know, they're wealthy individuals, they're institutional investors like, you know, EIB, European investment banks, etc. So people with significant amounts of money, typically VC is one of their investments. I mean, nobody would allocate, you know, all their money into VC, but they will provide the funds, okay? And the general partners will then set up a fund and will say, look, you know, typical VC fund runs for, I don't know, 10 years. We want to collect $100 million from limited partners. We call them over time. You know, you don't need the money immediately at all the time. And then we invest into companies. And the important thing and all of us are GPs, right? So we are on the left-hand side, the three of us. The important thing if we invest as a fund is that, first of all, we will make money, okay? And why do we need to make money? Because we will run Fund 1 and then, you know, hopefully get a good return. And then with the success of Fund 1, we would love to get the limited partners to invest again in Fund 2, 3, etc., right? And it's obviously our responsibility to make money for our limited partners. They trust us with their money, and we need to make some returns for them. And the way the returns are distributed in a typical fund is, go back, I'm sorry, that was a bit too fast, is 20-80. You will hear that quite often. So typically on the profit, it is such that 80% of all profit, for first of all, you know, obviously the limited partner get their money back, but everything that is a profit afterwards gets distributed 80% to the limited partner, 20% to the general partner. That's the typical scheme, how a fund works, right? So objective of the general partners that you will deal with is to make money. And we want to, you know, do this by investing in great startups, okay? That's how VC fund works. If you go to the next page quickly, VC is very different from private equity. If I look back at my McKinsey time, we did a lot of private equity work. These are typically, you know, hundreds of millions and billions that are invested in mature companies. You know, you come with a business case and then you want to have a certain return on this private equity investments. I don't know, 15%, 20%, something like that. And what you try to do as a partner in a PE fund is to try to make money on all investments. Okay, it's very bad, you know, because they're equally distributed. It's very bad that if you lose one of the investments. And you don't expect a massive, like 10x return on any of your investments that you do in private equity. Venture capital is very different. So what you typically see is that out of, let's say, 20 investments that the VC fund makes, only 1 or 2 are really home runs. And very often I've seen that in many cases in past funds where I've been involved, the 1 or 2 return the entire money of the fund. So, you know, if you have 1 or 2 investments in a 100 million fund, which generate like a 50x, you invested 3-4 million, it returns the fund. So basically 1 or 2 investments make a difference. Then there's a long, you know, like middle layer who typically return, I don't know, 2x the money that you invested in, 3x. You know, if you take that over 10 years, it's not such a formidable return. And then obviously there's another third which you will lose, okay? And the whole system is also designed that you lose. So we obviously don't like losing companies that go bankrupt, but it's part of the system. So this will also, you know, be important for your mindset, because if you pitch to a VC fund, you need to pitch that you're on the left-hand side of this dragon, you know, up the head of the dragon. That with you, we can make a 20x, 30x return. If you pitch to us, if you come to a VC fund and say, oh yeah, it's a good investment and you may make a 2x return, you know, the interest is gone, because we have to look for the ones that are on the left-hand side. Every single investment that we do at the beginning needs to have the potential to be on the left-hand side. If you're pitching already, or if it seems like it's in the middle of this dragon tail, it's typically not interesting, okay? So we really need to find high potential teams with game-changing products. Next page, yes. And then Aram will go deeper, but the way we look at these, you know, factors is typically, at least at the first cut, and then there are many other layers, but at the first cut, what is important when we, you know, we get thousands of pitches, right? So what we do first is we look at are you addressing a big market? If you're addressing a very small market, there's some funds who, want to invest in niche market companies, etc. But then you need a very high market share. Typically, we like more if it's a big market, it's a very relevant big market. So higher chances to be on the left-hand side. Obviously, also more competitive, but typically higher chances to be on the left-hand side. Number one. Number two is, if you pitch to us, we need to understand a bit, why the team is experienced and why you as a team would win there. And, typically there are outliers. Yes, there are people who don't have any background. I mean, if you take Meta, Zuckerberg, etc., he just studied in Harvard, did nothing else, and founded Facebook at the time. But that's an outlier. Typically, what we would look for is a team that obviously fits together, but that also has some sort of experience and ideally also joint experience. And experience can come multifaceted. So we're not like stubborn, you have to have worked in that industry for 5 years, but you need to have shown somehow, that you're a great developer or great system architect or data engineer in a relevant setting. You need to have shown that if you're the CEO, have shown some leadership, etc. So the typical type of teams that we're looking for is experienced teams, number two. And then number three, because we want to be on the left-hand side of the dragon, we want to have companies or pitches or startups that develop sticky and profitable products. Okay, so venture capital is not for the typical, retail bricks and mortar retail opportunity where you make a 3% margin on your sale or 5% margin. Not relevant. Will never be left hand of a dragon. Okay, if you're doing that, you need to have a product that is sticky. Typically, most of you, I assume, will do it in software, but in principle, it's the same for biotech. It needs to be sticky. It has to have high usability, simplicity, and it needs to promise at least some sort of high margin, and there are many types of ways how you measure margin, gross margin, retention, churn, net margin, EBITDA. But if you're pitching a product which is in a low margin area, it's already less attractive for us. So these are the three first checks that we do. Next page. I think, Aram, you wanted to show some examples there.
Yes, I'll comment. Let's stop actually on markets, and why actually it's important to have a big market when you are planning to play, because actually it's directly linked to expected return. Actually, there is some simple some math connection, between like return and market size. Let's go. Let's see actually on the left side, it's written like again, as Matthias told, VCs trying to find significant return, and to generate this return, you should have like high valuation. Again, if I start at valuation in 10 million, I expect that at exit you will have higher valuation, like 100 million, 200 million, and so on. And on the other hand, actually, valuation, in most cases, like maybe 99%, linked with revenue, because actually revenue is some indication of a scale and maturity of the company. And most VCs has some like mental benchmark, in 100 million revenue as a sign when the business is big and ready for exit. Of course, in some cases, this value can be lower. In some cases, it can be higher. For instance, like in database area, again, it can be like 20 million revenue. And with a super great product, you can sell a company for like 1 billion. But for like online to offline businesses, you can have like 200, 300 million revenue and sell it like at the same price. But the point here, you should reach quite significant size of revenue. And the last part, to reach this type of revenue, you should play on big market, which allows you to reach this size of revenue. And again, then larger the market, then easier, to reach this mental benchmark. In other words, if I'm playing in market which, I don't know, like in 10 billion or 20 billion, What does it mean like 100 million? It's only like 1% or maybe 1.5% of shares. Looks like okay. You shouldn't be like the top leader. You should be only one of the best ones. But again, if I'm playing in super small niche market, with size again like 100 million or maybe 200 million, it means I should have some monopolic yes position. And actually it's too hard. It means you should have like total leader in this niche. I mean like as bigger the market when you are playing is better. Actually on the right side some simple example which actually presents what I described. And again, the key point, please focus on big markets because again, it gives again in a mind of investors that they can have opportunity to make big return. And actually, there is one example, yeah, to illustrate real case scenario, yeah. Now we know like we are moved in Gen AI boom, and AI market is growing so fast and actually is so big. Only like Nvidia, yes, generates like more than 100 billion in revenue, yes, selling their GPUs for data centers. And actually this revenue is only growing and it will grow because again, like whole big players like Google, Amazon, Meta, they increasing their spending to GPUs because they want to implement more use cases based on Gen AI models, which will increase like the number of chips that they should use. It means again, it will be like even bigger market, like 300 billion. It's super massive scale. But here actually the opportunity because again, when you are buying some kind of chip from Nvidia, you in reality pay again like if you buy some chip for like 50K, the gross margin actually for Nvidia is like 80%. It means if you are buying at larger scale, you somehow like subsidize as a for Nvidia profit. And of course, when you're a big player like Google, Meta, Amazon, or like even Huawei, yes, you doesn't want to subsidize some company. It means you want to build something internal. Yes, you want to build your own chips, and it means you should build some new novel architectures, find some new solutions, and so on. And at the end, you can build it in your in-house, or maybe you can bought the team with already established solution and work with them. So that's why we decided like to invest in Lumai, one of our portfolio company, which developing new type of architecture of GPUs. Yes, they are building optical GPUs. Why? Again, they are playing on big market. It's number one. And second one, we really see like some rationale around it when they will make exit as soon as they will have some significant results. I mean, like from financial results or even like product results. That's why, again, we invested with guys because again, they are playing not in niche market. It's super huge. And even if they reach less than 1%, again, it's done. We will have not only return of our fund, we will have maybe like 2, 3, 4x return of our fund. It means, again, market is crucial. Next one.
Yes, so for sure, market is crucial. And first of all, we are looking at team and founders who can, let's say, achieve with their product the best results in these markets. And we are looking at both significant experience in technology, business, and science of founders if we are talking about some scientific approaches, as Aram mentioned, for example, in Lumai. Yeah. And as you know, like building a startup is really, you already know, it's really tough thing. and you have to be, let's say, both ambitious to work 60, maybe even 80 plus hours per week. You have to be able to optimize your time, both working and personal, and play in between. And to be adaptive and dynamic to achieve best go-to-market strategy, to optimize and handle your team, to handle your communications with customers, clients, and partners. So many components inside of this tough work. And for sure, we are looking at founders who can achieve, let's say, some optimum in between these components. And as a part of this, we are looking at experience and very important, investing in our verticals like B2B, SaaS and software, deep tech and educational technologies to check previous tech experience of founders and of the team. So for example, if you were spending like 8-10 years in scaling company, building tech infrastructure from scratch and managing 100, maybe 200, maybe even 500 team members in a peak, then previous business experience, you could have founded and sold, or even it could be a failure, a few companies, gaining a solid understanding of what to do next. And strong academic or technical credentials, it's more applicable for scientific startups like Lumai, for example, but we are looking at founders' Hirsch indexes, citations, then grants, patents, and so on. And in this slide, you can see also sweet spot of age of unicorns founders, which approximately between 30 till 50 years old, but for sure there are exceptional ages before and after. And next slide, please, Aram. Yeah, so here we would like to show you examples of our founders from our core portfolio. This is experienced founders who founded several companies, or at least one company. For example, Bismarck. Bismarck is so Bismarck develops software solutions for automotive applications, and founder and CEO Tero. He previously founded several companies and had one successful acquisition. And also he served as a CEO of mid-sized company. So in other words, he has like significant CEO experience of creating and managing companies. Then our another company, Gcore, which produces AI infrastructure solutions for enterprises. The company was founder of management team and founders of Wargaming, and Wargaming is one of the most successful and largest gaming companies in Central and Eastern Europe region. Gcore was founded by Nick Katsalapov and Andrea Reitenbach. So also experienced founders. Then Awesome. Awesome is accounting services and assistance for SMEs. And the company was founded by Viktor Lysenko, who is very experienced and previously founded Rocket Bank, for example, which is what was also leading neobanks in Central and Eastern Europe regions in 2010s. A new AI company founded by David Young. David Young, most probably all of you or most of you know him. He's a founder of like tens of companies, and the most successful ones were Abby and the main product of Abby, Fine Reader, probably you know, and Aika. This is restaurant soft, management soft. So yes, this is like major experienced founders, but we have not only such type of founders in our core portfolio, but also young, very ambitious founders with great scientific achievement by the date. Aram, please, next slide. Yeah, so we have founders of Lumai. About this company we already spoke. So both James and Xen, they were in Oxford laboratory, and they were inventing technology, current technology of Lumai together in this laboratory. So they have great already scientific results and managing several PhDs and postdocs. Kunami is quantum sensing company out of Basel, and actually 3 co-founders, Matthew Munch, who is the CEO, Alexander Stark, and also Patrick Maletinsky, who is not on this slide. He's the chief scientific officer. They founded this quantum sensing company, had previous great experience in PhD in quantum mechanics, in quantum sensing applications, and also in quantum neutrogen vacancies out of Harvard, for example, for Patrick. So they are scientific experienced people. And also one more company, Architonics. They're producing first all optical XPUs, and both co-founders, Michael and Leonard, have quite significant experience. For example, one of them graduated and worked in Max Planck Institute for Science and Light. So we are not looking only at, let's say, major experienced founders with several companies on board, but also for young but ambitious and with great scientific results or technological results founders. Next slide, please. Yeah. Then next stage and next metrics in which we are looking at are product metrics and unit economics. So a combo of product capabilities and features along with financial and economics indicator. For sure, there are different stages of early stage startups. For example, when we are looking at pre-seed startups, we are more focusing on value proposition and vision, how you as founders and team members are showing this value proposition and vision to us, and less on numbers because there are not a lot of numbers. Yes, typically you have in this pre-seed stage like IRR of up to $100,000 or euros, maybe $200,000 or euros, and maybe you have some, in addition, non-recurring revenue. But this means that at the pre-seed stage, around like 80% of our focus is on vision and future roadmap, future go-to-market strategy, and 20% on numbers. If we're talking about seed stage or pre-A stage or even Series A stage, in this stage you already have like 1, 2, maybe 3, 4 million IRR, or you should have, let's say. And here we are focusing like 50-50, 50% on product metrics, go-to-market roadmap, how you will scale your product to achieve, for example, Series B funding, Series C funding, and 50% on unit economics metrics. Next slide, please, Aram. Yes, and when we are talking about unit economics, some metrics in which we are looking at are related to IRR growth and retention, then go-to-market execution and performance, like account executive productivity, then gross margin, gross magic numbers, net magic numbers, CAC, expenses and profitability, like operating expenses, and financing and valuation, like EBITDA margin, like enterprise value per IRR. So these like key metrics, for sure, they should be applicable, let's say, to your numbers, and you should check it on your side. We are waiting from you when you are providing them correctly to us, but usually we are also checking them on our side, and sometimes our calculations are different, and then we should come to some joint calculation together. Thank you. Aram, next slide, please.
Okay, I think it's me. Guys, if you, Irina just mentioned, if you want to ask questions, just, pop up. I want to make this a bit interactive if you want. Otherwise, we can also ask questions at the end. Please feel free. Now, just interrupt me. The point is, okay, so first we do, as we described, due diligence, we look at the market, we, look at the founding team, we look at, how you deal in terms of economics and KPIs, et cetera. And what comes out of this discussion, and this is a, several weeks, sometimes even months process where you interact with a fund. And obviously you do that if you're so far, you do that with several funds because you need to maximize your chances that one of them will invest. But then if you made it through this entire process, what will happen is basically, our team, like for example, Aram would write a memo, and the memo will be discussed, okay? And the way it works in that discussion is the following. So first of all, left-hand side, you have the general hierarchy of the VC firm. So you have partners, managing directors, who, are in reality most relevant people for you. Sometimes a fund also has venture partners. They are more experts on certain domains. So typically they don't participate in decision making, they don't work full-time, etc. And then you have a hierarchy of people below, and you would typically deal with associate analyst, senior associate, but obviously you would also eventually pitch to all partners, because otherwise how can they make a decision if they don't hear you live, okay? But basically the way it would go, then you would go into an investment committee. So in our case, for example, we have an investment committee approximately every 2 weeks, which also means we don't take a decision like in one committee session, right? We do 2, 3, 4 sessions and we discuss it, etc. The associate or senior associate would present the investment. He would distribute the memo. We would have a discussion. Everybody comes, with questions, and then typically it goes back to the associate, and he will collect more information, and then we have another discussion, etc. So we'll go several rounds, also input, suggestions, what could be deal terms, etc., term sheet. And then eventually we will take a decision, yes or no, and how much to invest, okay? So that's the investment committee. We go to the next page. Very important for you to know that, first of all, a no is not the end of your company. It's the no of, this particular fund in this particular situation that, decided not to invest. And why would that happen? Many reasons, right? Can be extremely broad, but for example, it's, revenue opportunity is not large enough, or market is not large enough. So we don't believe you will be on the left-hand side of the trading that we showed at the beginning. Or second, you will, as Marie said, you would come to a fund typically if you have already some revenues, some ARR, if it's a software company, etc. And we need to understand, the metrics, and obviously also how you calculate the metrics. There are 100 definitions of ARR. Everybody does them slightly different, and funds are used to being, told a bit of a, pink version of the world, and then we will need to check, and we need to see how it's really from our point of view, the economics, etc. So that's another example of how it could go to a no. Sometimes it's also, team is lacking expertise. We had many discussions where we felt, okay, cool, product is cool, even some traction there, but we don't feel that the go-to-market to really scale it is there. Maybe people are missing in the key geographies. Maybe we feel the sales skills are not strong enough. Maybe you feel the technical mode is not strong enough. So, I mean, you can imagine these are the kind of objective reasons. The other thing that you need to manage is also subjective things. So every decision is taken by humans, and there are human elements. So you should, make sure, as far as you can influence it, that all partners actually read the memo, that they understand it. You should test in some sort of way if the fund is really, able to finance also new investments, because you raise money over time, you're right. If you have 100 million fund, it's not like you have 100 million immediately in your bank account. You will collect it over time, and you will do capital calls. And sometimes the fund, wants to have a pipeline, but then decides, well, we rather preserve our cash. Or thirdly, and that's always the case, I mean, we need to maximize the return for our LPs, the ones that I mentioned at the beginning. And you're obviously competing against other opportunities. So if a fund has many other opportunities that could be on the left-hand side of the dragon, you might get a no despite that everything is in order. If we go to the next page, and then I saw we had a few questions, so maybe we do a small, well, maybe shall we take some questions now?
Yeah, I think so. I mean, I can be the voice of the questions from the chat. Celine is asking, how does startup valuation change based on key metrics like MRR and traction? What's the best time to approach VCs? At 1, 10, 100K MRR?
Okay. Aram, you want to take this? I'll distribute it a bit so that you hear perspectives from all of us.
Yeah, actually, again, there is no threshold, to be honest. Yeah, because again, there are many funds. Yes, some of them actually focused on pre-seed stage, when for them maybe 10K is okay. Some seed stage fund, for them actually 10K is not enough, but 100K MRR is okay. I mean, there's no, again, it depending on the fund. This is like maybe generic question, response. But there's also another angle, yes, to maybe cover this response, to cover to this actually question, yes. I think actually the best strategy to came to VC at higher like revenue. Again, the reason is quite simple. As early as you come to VC, as lower your valuation will be. Yeah, and again, it's a totally different story when you come to VC and you have like 1K in revenue. Again, it's nothing. It's like zero. That's you can receive again if you have like ideal product. Yes, on a paper you have great team and so on. You can receive like term sheet with quite small valuation, like I don't know, like 2 million cap or maybe 3 million cap. And if they will invest like 300, they will reserve like 10 or maybe 15% ownership. Actually, is a lot, yes, in the beginning, because again, you will be diluted in time many times, and at the end, maybe you will have a small portion of ownership in your company, and it is not good. That's my advice. Yes, come to VC when you will have quite significant numbers, because in this case, you can fight for your valuation. Like, again, guys, if you have like 1 million ARR, our valuation should be like 20 million. In this case, if I'll invest again like 500K or like 1 million K, I'll receive not like 15% of your company, but only 5%. It means you will be diluted not significantly. I mean, like try to come to VCs as later as you can. Because again, and actually it's about my next slides, the dilution is quite important. Yeah. And like building MVP is not as hard as you, again, imagine. Because now we have a lot of tools, yes, like AI tools and so on, which helps you to build something in weeks, which we spent like 4 or 3 years ago in months or even years. And you can easily test, yes, and abrogate actually your idea. You can build MVP, test it, and see there's some product market fit or not. Get it? I mean, again,
also
so
probably,
the answer is it depends. I guess the answer is it depends. It depends on how much funding you have on your own. Don't come too early, and show a certain number plus a bit of if the number is flat forever, you don't get anybody excited either. So momentum also matters. So it's not only a number but also the momentum.
All right, thank you so much. And also the question on about the statistics slide that you have shown. Why is there a consideration based on age/gender when skill set is more promising? Okay.
Marie,
It's like not consideration. This is current statistic of unicorn founders. So unicorn is a company with valuation more than $1 billion. Yeah, so it's like we just took current statistics of such companies and their founders, and these results came from these statistics. It's just statistics.
So it's just a matter of
numbers.
how this media was counting, I guess, this channel. So yeah, but it's also easier, I guess, to do it with age and gender rather than skill set, because also of different like cross-discipline skills that the founders can have. All right, thank you. And also now Igor has joined with a question. We are a risk capital investment. However, we get investments. What type of risks are business angels and VCs happy to take, especially when it comes to tech hardware companies in B2B? What type of risks are less comfortably to be taken right now? Okay, tech hardware companies in B2B, risks for investors.
well, let me try and then Marie jump in. So first of all, if it's tech hardware, it's not software, it's deep tech. I mean, inherently, I wouldn't say it's more risky, but it has the notion. Many people would say, hardware deep tech startups are more risky because the market maybe doesn't exist yet, because the science is at the beginning of the development curve, et cetera, et cetera. So inherently, it's often perceived as more risky. I mean, if you have a software company with 10 million ARR, it's got good momentum, et cetera. Yes, there's obviously a risk, but it's more doable to project how the company would look like in 2, 3, 4 years. Deep tech is different. I mean, the way we would look at that is, first of all, we would do a very, very thorough research of technology and science, and is this realistic? Are the founders coming from a research group that has experience in there? How does it compare to other technologies, etc. And if we feel there's like a red ocean where many people have tried the same technology and have failed, probably we wouldn't want to take the risk. If we feel it's very different from others, or it has a very deep scientific foundation, we would take a scientific risk. What we would also do is, contrary to software companies with revenues, etc., we would take a risk probably on go-to-market capabilities. We wouldn't mind too much if these are more scientific and technical founders and they don't know how to do the go-to-market. They can probably hire somebody later on. So we would be comfortable with that risk. What personally and it's always a bit personal, wouldn't take a risk is like, I'm personally very skeptical on these crazy moonshots. Okay. So, I just got last week a pitch from somebody who wants to do mining in space with some, satellites, and then, refuel the rocket that goes to Mars, et cetera, et cetera. I mean, this is probably scientifically, for sure, scientifically not proven. It's a complete moonshot. If there's ever a demand, it's very unclear if a startup, in this case it was from Europe, would ever get traction in the US, etc. So if it's too many risks that you see accumulated, maybe some people take moonshots because they want to. But if we take our responsibility serious, as I said at the beginning, that we need to earn money for investors, we probably wouldn't want to take that risk. So it's a combination of many things that we wouldn't like, and we would probably not take that risk. So, and we're taking, I mean, if you talk about Constructor Capital, we do a lot of deep tech investments. Aram showed Lumai before. This is high risk, this is optical computing, they're at the MVP stage or even pre-MVP stage. But we took the risk because we felt, there's a scientific base for that. They have lots of good publications. They have excellent founders who have an excellent scientific track record. They do it very, very different from other optical compute startups or optical communication startups So there we could live with the fact that, you know, we take significant risk. I don't know if it answers the question, but it's obviously a multifaceted approach. But if you have to, you know, if you list all the risks, if everything is high risk, you probably will get a no. I guess that's the answer.
Igor, maybe in this case, since it's just like a broadened question, maybe something specifically that you want to know, or like, does it answer, or?
I
Yes.
guess it is a broad topic in general, but yeah, I thought now in this time of the economics and this time of technology, if there was a shift, what risks are rather taken now than were not taken before, and vice versa. Maybe what is right now a no-go, especially for hardware companies. And to be clear, it's not really deep tech, it's just hardware, scalable hardware, but the technologies, and there's not a lot of science involved.
What kind of hardware are you talking about?
Solar energy and a small a slight mechanism that rolls up and rolls down. So it's nothing very complicated. But it's in the solar energy mixed with water technology. So generating water where you generate solar energy at the same time.
Okay.
But it involves a mechanical.
Yeah. I mean, obviously I didn't read your pitch deck, but you would probably, and I'm happy to take Aram and Marie as well, but you would need to convince me why, you know, solar is a bloodbath, as you know, right? And Europe and US has lost solar completely to China, and, you know, China is producing solar at scale. And, you know, it's obviously very, very important for the world and for reducing global warming and alternative energies. But you would need to convince me why your technology is like, you know, not 10% better than the cheap solar panels that you would get from China, but maybe 200% better. And you know, why there's a chance to, unless you found it in China, why there's a chance to scale it. I mean, look at you know, the battery factory that went bankrupt, the Swedish, what's called North something. You know, they wanted to build batteries and compete against the Chinese, and they had, you know, even lined up all the automotive players in Europe as their customers, and they failed. They failed, you know, relatively rapidly, and, you know, with a lot of money lost. So I guess that would be one question that I would ask, and, you know, you would need to convince me that it's worthwhile taking that risk.
All right. Yeah.
Can I
Yes.
ask a question?
Yeah, just once a question, Yuval. There was a question already in the chat, and then after that, I will come back to you, okay? Perfect,
Cool.
thank you. Yeah, because it was also like, it's not related to the risks, and it's related to another types of risks, as I also understood. Just an opinion from your side about product-led growth with open source, with AI, like with newly coming trends and booms, and VC relationship, because right now the development is rather cheap, and also no-code development, and also AI or LLM usage is kind of on the wave. Like, what do you think about that? Do you think it's a negative trend for Constructor Capital to see the team who is using that? And yeah, please, Vitalis, if I am already, you know,
Sure.
inventing some other question, correct me.
No worries. No
Yeah.
worries. Happy
Marie,
to
you want to
support
take it, or Aram?
Yeah, sure. So frankly speaking, when we are looking at startups from Constructor Capital, we are looking, let's say, in the final product and go to market and so on, which we already discussed. And if there is a part of, let's say, logical AI for this product, we could consider, we could invest. But the main question here is like in IP and protection, that nobody will repeat what you are doing using, let's say, some existing LLMs and so on. If we see this as a risk, we will not invest. Yes, if we see that there is no risk for any reasons, I mean that you somehow build something unique, even using existing, I don't know, LLMs, we could invest. Yeah, but this is like case by case. Sometimes this type of businesses, and we recently looked at such type of business, which has great execution, really great execution, but they're using existing LLMs, and they could be replicated, I don't know, like during 1 year or so, or maybe half a year, or maybe 2 years, but it is possible. And in this case, we decided, for example, not to invest. I don't know if I answered your question, but I
Not
got it
really.
in this way.
I think partly, but thank you.
You
So
can let's say specify.
yeah, sure. So the main roadblock for the enterprises to adopt any technology nowadays, it's like being proprietary, meaning that all the SaaS that are presented in any given market are literally becoming a commodity. And exactly your statement, as you did regarding it will be copied in 2 or 1 year or something, it's exactly the main issue for any companies being adopted by the enterprise, meaning like if Volkswagen wants to have your brilliant SaaS, it can be literally copied in few years. So it leads to such a thing that the distribution adoption by Volkswagen will be more important, meaning that they will need to have like a open source version of it, and then being adopted with their developer team or their infrastructure and so on. So my question is that if product becomes a kind of a commodity, then the distribution and adoption within the enterprise becoming a norm. And yeah, if you're not a Microsoft or Salesforce, you're as a small scale or middle scale SaaS, you're pretty doomed due to the fact that any technology will be just copied plainly. And my question was like, what is the relationship
But
between the VC?
there's obviously a big debate. But if you think about, all these no-code, low-code platforms, they don't get traction beyond MVPs. Sorry, Builder AI just went bankrupt this week with billions of funding, right? And they built a no-code, low-code platform, and they were used for MVPs. But then to build enterprise quality software, you will not do that with no-code, low-code software. So yes, it accelerates things, but the winners will still need to have good original product management, still need to do a lot of development on their own. I don't think it will be, even with AI and no-code, low-code, be replaced.
Thank you, but
No,
I didn't mention.
I can comment actually. I
Yeah.
can comment. In my point of view, actually, again, the picture actually is following. By using all, as you mentioned, like AI making, yes, creators, you can build, again, like MVP-like stories. But it's more about like quick die. Like you can build it, test it, it works or not works. But to build the really working MVP, you should have some industry understanding actually. Like you should have industry expertise to write like correct prompts, yes, to build exactly what will be fitted. And of course, we can create like easily any MVP now, but it will be totally fit with industry needs is questionable, and you should have a clear, deep understanding actually what's needs and what not. And in the first starting point, like building MVP, in my understanding, okay, is by using all these tools, it started to be much easier. And you can come to like first your 100K revenue, like 200K without any significant investments, like on your own. Because again, building like MVP, I don't know how much it costs, 1K, 2K, 5K. Again, anybody can sponsor it. You can play with it. If it works, again, if even if you lose like product lead grow, again, you can reach like 200K or like 300K revenue in couple months. And after that, you are starting to like coming to point like what is the next? How can I scale it again more? And at this point, you need like some more investments to build like sales machine. Again, like back into your question, yes, now it's easier to build something, but to being like having like super sticky product market fit, anyway, you should have some expertise. It can be done like from guy from the street. Yes.
Yeah, sure. That's why I'm asking, because I was working with Volkswagen.
No, I mean there shouldn't be, again. I mean like there shouldn't be any fear yes, that anybody come and copy. To copy any solution, you should have quite strong understanding actually what needs.
Exactly.
Of course, if you go to build some messenger, it's not so hard. Everybody use messenger, that we understand what is a ideal messenger looks like. But if we are talking about super niche product, like again in B2B, databases stuff and so on, believe me, if I have like Cursor and all our stuff, it will not help me to build something unique, because I know nothing about it. But if some guy knows a lot of it, he will build it.
Okay.
I mean, like, anyway, knowledge is a king, and expertise is a king.
Exactly. And but that's what my question was about. Yeah, that it's not about the no code or something. It's about the expertise and people like me being able to open source this expertise and present and give it back to the company I was working with.
Yeah, correct. But again, the key point with all this no code stuff, yes, like Cursor and so on, it helps you run faster. Because again, like before, let's imagine like 5 years ago, you have brilliant idea, you have understanding what to do, but realization will take time. You need like some low-level engineers, blah blah blah, and you need money at the end, because you need people who will write like 10,000 of lines of code. But now you don't need these like 2-3 engineers, because you can write correctly prompt, and it will, and again, in ideal world, it will write you these 10 lines of code. It means the entry barrier, yes, is decreasing. And you can test maybe not only one product, you can test like 5 products at one point and see which one actually demonstrates, again, higher stickiness. And as soon you will find with product market fit, now in this moment, you can go to like some venture capital funds and ask them to fund you, because you have some metrics, you have some meat, and now is a time to build like some sales machine. I mean, like now we are shifting to this story of building of products. Like I have some idea, I do it fully on my own without any internal like pre-seed investments. As soon I see some product market fit at seed stage or maybe CSA, I come to VCs. But again, it's a good sign for founders because you will save your ownership, yes, a bit longer, and you will have not high dilution. But again, it's like my ideas.
Okay, let's keep on going.
All right. Yes, we have one more question from Yuval, if we can afford it, but I hope so.
Yeah.
So,
Go.
yeah, how do you calculate the valuation of a deep tech startup with no ARR and only bootstrap level funding? I love these questions because it's like 1 hour ahead that we can discuss it.
It's very complicated. I don't know. I mean,
it's complicated. I can maybe take it.
Yeah, Mariko.
It's complicated. It's usually, or sometimes it is subjective, frankly speaking, and it depends on anyway if you raised some capital with some valuation before or not, yeah, or it's first fundraising. But usually,
if I may, in my startup, I've mostly invested my own money. So I invested about, let's say, $100,000 of my own money. So
yeah.
How can you evaluate it?
Yes, we will take a look into competitive landscape. Yes, and current valuations in competitive landscape and also in some locations. But healthier, let's say healthier structure, if you're talking about, for example, equity round, that after this equity round, you will be diluted like up to between 10 till 30%, 30. It could be a healthy structure. So in terms of this, we could propose some valuation. For example, if, for example, you're raising 1 million, we could propose like 4 million valuation post money. Yeah, so it could be in this way. If, for example, some VC would propose you to be diluted like 40, 50%, it would be not healthy for your startup. Yeah, so this is like subjective, and you should also look at competitive landscape, how it works for your neighbors, let's say. But something healthy between 50 till 30, maybe sometimes 35% of dilution after the round.
Yeah. Point is, it's subjective. It depends on how much you need, and you need to find a fund who treats you fairly. Because as Marie said, if you immediately lose in the first funding round 40, 50% of your company, it's not good for you. It's eventually also not good for the investor, by the way.
Yeah. And it will be difficult for you to fundraise next round.
Exactly.
So it mostly depends on how much I want to, on how much funding do I need to get to my next milestone.
Yes, exactly. So you need to show us some roadmap, and for how long time, so how long you will spend the current round, and when do you need to raise next money, and on what you will spend the current round, and so on. Yes, exactly.
So I need to show you like a path to an exit, and from there we can.
Oh, well, path to an exit is very long. Just show, your next take Lumai as an example. Okay, the next milestone. I mean, they proved scientifically that we discussed them. The optical computing. They proved scientifically that it works. Okay, so got good publications, etc. They need to get to the MVP. Okay, MVP is a product that they can show to customers, that they can maybe even sell a few pilot versions, etc. That takes them, I don't know, $25 million, for next year, or $10 million. Then they should raise that much. And then you need to find a construct where, you don't do the 10 million raise at a 10 million valuation because you get diluted immediately. So intelligent investors would understand that, right? They want you to be incentivized, right? I don't want, the worst companies are where the founders are diluted to zero. There's no motivation anymore. There will be no outcome. We have some of those that happens over time, and it's like pulling teeth to these founders and CEOs.
All right, thank you.
All right, let's move on. Thank you so much for this.
Okay. I think Adam will wrap it up, and then we.
That's fine. Again, I've covered all these points about like dilution, blah blah. So only actually presented in structure weight, and now I think yes, we can come to summary. And again, let's repeat. Yes, like the funding is important, and successful funding again it depends on some many factors. Most of them actually sometimes random, but again. For VC, like evaluating a startup, it's relevant, again, it's based on some metrics and parameters. And the key one, as we described, yes, is a market, which should be quite big and growing. Second one, team should be experienced. Again, this experience can be demonstrated in many ways, yes, based on your like excellent research which you done on your like PhD or postdoc, or based on your work which you done like in industry and you build something. And last one, the product. Yeah, it should be strong and sticky. And good illustration for these parameters, yes, like strongness and stickiness, it can be some P&L matrix. Again, it works only for product which has some metrics, but again, if it doesn't have, it should be like quite clear vision what product is, who is your customers, and so on. Again, it depending on stage, yeah. And again, when we have all these points in a place, yes, investment team prepares quite comprehensive analysis, like memorandum, which presented to investment committee, the decision makers, yes, and they make the decision, like go or no go. And sometimes, again, this is a quick important point. Yes, a no go can be like it's sometimes can be quite subjective, and it does mean like startup bad or something bad. That's why maybe you should knock the door like again and again. I think you should do it like maybe 10 times, but you can do it like twice or maybe 3 times. Yes, because again, maybe today is a no go, but tomorrow it will be like go. And also, like you being a startup, yes, and raising the money is it means like communicate with like hundreds of funds, because based on like known statistics, yes, the take rate is like maybe like 5%. It means like if you will talk with like hundreds of funds, you will end up with like term sheets, maybe with only 1, 2, or 3. It means you will talk a lot. And to make this communication is simpler, my advice to be prepared to it. It means like you should have quite clear and structured data room with all needed information. I mean, like clear and structured pitch deck, quite clear and structured financials, product and like competitors analysis, and so on. It should be, again, you should send like some link to your data room, and the person who will analyze it, he should back you maybe once or twice. It shouldn't be like the ping pong discussions, like guys, could you provide this, provide that, and so on. That's why I suggest to do like your homework before and spend as much as possible time, because in further you will spend less, yes, in communication, then you will have quite well-structured data set. And last advice, don't rush into fundraising. Yes, try to bootstrap in the beginning on your own. And again, as I described, yes, thanks to AI tools, building MVP and reaching users is now as easier than ever. Yes, like in the last 20 or 30 years. And the more metrics you will have, then the more valuation you will have. It means like less dilution you will face. And at the end, at late stages, yes, your exit will be successful. That's please trying to, again, trying to bootstrap the beginning. Please like advice. And come to like VCs with already some meat. This is like, again, short summary of what we wanted to like cover, yes, and make some advice for you regarding this topic, yes, of fundraising.
Thanks, Aram. So we take a few more questions if you want.
Yeah, thank you so much, Aram and Matthias and Maria. Yeah, I think that now you can just, the dear team members, founders, you can just raise your hand, and yeah, with your voice track comment, it will be much easier and simpler to answer your questions or concerns, because maybe you have some, I don't know, stereotypical opinions going around regarding from the tools to the fundraising process to the expectations of the investors. So now you have direct contact that you can turn into your knowledge, your asset, that Aram says is the king. And I fully agree. All right, so questions, comments, any types of concerns, maybe stories. Maybe you already want to share your story of fundraising and say, well, this statistics is not right. I don't know, with outreach, for example, to the investors, or anything in the process, within the process. Yeah, just feel free to raise your hand or unmute yourself. Actually, I think that it could be the shortest way and the most effective one, since we have a little bit of time. Okay. I see everyone is digesting the information probably. So yeah. Yes, Igor.
Thank you, Irina. Of course, I will take this opportunity to ask. So what we are developing is hardware, and it comes from a niche where you generate water from the air. and this is our specialty, our expertise. We come from the water sector, and we are also mechatronics. So blending in the solar energy is quite easy. And as fairly put out before, that the Chinese are in this sphere dominant. Now I went through what is our unfair advantage, and to be honest, all the unfair advantages are at China's side. Now we do our strategies is Chinese. This is maybe something that might be an unfair advantage to other teams, but compared to China, I think it's difficult to say that we have an unfair advantage. So my question is there, how would you frame your startup? So putting in my role on this vast market with a difficult competitor from all sides, if you don't have this unfair advantage.
Yeah. Oof, it's tough. Look, I mean, obviously you could try, first of all, can you protect your IP a bit? Can you have patents, etc.? I think that's maybe a first layer of defense, Igor, if you develop something in that space, so that you at least you can prove to investors, but also to customers, etc., that it's somehow unique what you're doing. Second question is, can you maybe build an MVP here in Europe or in US or wherever you are, and then find a partner with a Chinese company? It's obviously especially nowadays with the politics getting more and more difficult to get to a partnership with the Chinese companies, but they exist, right? I mean, even for larger companies, they exist. You always run the risk that they will eventually take over the technology, develop it themselves. We need to go deeper into what makes it unique, but just, and this is not a startup, but in Switzerland there's a company called Meyer Burger who developed very unique for the solar industry. Initially it was saws, basically how you cut solar panels, and very unique, and they had a big market, and they eventually sold it to to a lot of Chinese solar manufacturers. But they eventually, took over the technology, even though they had IP protection, took over the technology themselves and did it themselves. And then, the Swiss companies say, yeah, okay, then we can't compete anymore because, biggest market is China, only though they produce solar panels. And then they said, we should develop high quality solar panels, much more effectiveness, etc. But even that, with the cost curve against Chinese, it's almost impossible. I think they're really struggling. I mean, I don't know exactly what your company does, but it's tough. I mean, you need to think through, what could be partnerships, maybe what could be IP protections. How can you make it unique that you can compete in a hardware scale market where cost curves matter eventually a lot.
Okay, thank you.
But
So
happy,
maybe
I mean, what we can offer you, send us, once you have it, send us your pitch, send it to Aram, and we're happy to brainstorm with you. It's probably more practical if we do it on a concrete case.
yeah, happy to do that. Of course, thank you.
All right. Yes, Yuval, see your hand.
Thank you. Would you rather have, as an investor, say in the strategy, or would you rather the founder would come with a complete, concrete strategy for the market entry? What would you rather have? Do you guys like getting involved with the management of the startup?
Okay,
Or,
Marie, you want to take it?
I can take it. Yes. So it depends on, for example, in our core portfolio, we have 80% of board seats currently, meaning that we are participating in board discussions. Usually it's like once per quarter or so. And there are usually other board members, typically between like 3 till 5, 6, mostly 5 in your stage or in early stage, and the board is acting like finally together. And board could for sure help with some management things, execution, and so on. For example, we as a board member, together with the board, did something related to management help for one of our portfolio companies called Awesome, which we already discussed today. And we helped them to hire new CEO to the company, and to hire new CFO to the company, and to change somewhat the management. So we could participate, and it depends, let's say, how good we understand the business, how good we understand the go-to-market, and exactly where we could help you. In our case, Constructor Capital, we try to invest in startups which we could build by ourselves with some, let's say, external help. So we should understand like your business pretty well. And in this case, yes, we could give you advices or as a board vote for some changes, but it's not like in every case. So it's like case by case.
Great, thank you. So, and another small question that relates to it. Are you guys trying to create some kind of a synergy within your portfolio? Is there some kind of a grand scheme of things when you invest in companies? You try to make them match inside the portfolio, or?
Yes, it could be. I mean, if we see, for example, as an investor in like in all our portfolio companies that there could be a match, we could introduce you to each other, or you could ask us if you see, yes, that there is a match, you could ask us to introduce you to each other, and then you're taking from there potential partnerships or whatever. Yeah, so we are looking from our side, you're looking from your side. Our portfolio is open, you can see it in our website. Yeah, so it's like any ideas to grow your business are welcome, and we will support it for sure.
Right.
And even beyond our portfolio, right? I mean, in our
Yeah.
specific case, obviously, Constructor Capital is obviously a bit of a function also of, the other things that the founders did, like Acronis and, the entire network that we built over 30 years. So.
All right, great, thank you. I'm glad.
All right. More questions, more comments, concerns, and stories. I think everyone is like, thank you so much also for the team to kind of go into this personal mode of the cases. Yes, Alejandro, I see you unmuting yourself.
Yeah, sorry. So I was wondering how important is the level of, let's say, coverage of the patents. So patents is, for example, in my case, I have 2 provisional patents. And I was wondering I should go for PCT, but PCT it will make me spend a lot of budget that not precisely I have, and I don't know how strong will be this compared with just presenting to the USA. Just to not drain all my budget, even considering that my main market is global, but my main market is in USA. So how VCs looks at the, let's say, startups that spend, I don't know, hundreds of thousands of dollars trying to cover every single country for one pattern versus, let's say, cover 5 patents in USA.
No, I think you should not bother with. I mean, if your main market is US and you want to protect it with patent protected there, don't bother with trying to file 20 patents. And even there, I mean, I'm not an expert, but we have, for example, a partner who is a patent attorney. She's very experienced. If you have a fund that's interested in you, they can connect you to the right people to provide you with also value and cost protecting strategy, how you do patents. In principle, if it's real IP, you need patents, but do it smartly. I mean, your job is not to file patents. Your job is to create a good technology, and the patent file should be second thought, right?
my impression for several patent attorneys that I spoke is that they basically try to get as much as they can now, because they know that most of the startups will maybe fail and the patents will not be holded for a long time or whatever. So they always trying to add all these small add-ons to the patent to try to get as much as possible. So that's kind of I don't know, like a war or yeah.
Yeah. Yeah. I mean, again, you would need some neutral advice. I mean, like, you know, in your specific cases, it's difficult, but for me to say something, but don't, you know, obviously they want to sell you your services. So try to get also from somebody who is a bit unbiased, who doesn't necessarily want to sell your services, get your advice.
Okay, thank you.
Thank you so much. All right, we have one more question, one more case oriented if you want to ask anything. All right, I see people already digesting all the information. That's good. And yes, Andre from Iperon.
Yes, I have a question. We found a kind of paradox when we talk with investors, because at one moment some of them says that we ask from too little, and the other time we talk with them and we say, why we need so much? So how we should handle this? Because in my opinion, I think we can get to the point where we launch a product with less money, but then when we talk with investors, they say, oh no, some of them say, oh no, you should ask for more because you can accelerate the marketing and so on. And
Well,
then
if
the
they
next
give you more,
person,
take more, right? In principle, if there's money on the table, take it. If you don't get diluted too much, right? Don't turn down money. You know, if the guys tell you you should raise more, well, fine, okay, I raise more, but the valuation goes up, right? Be a bit smart. But in general, you're never overfunded as a startup, right? So you have the opportunity.
okay,
Yes, I see also Selim's hand.
What is the general rules related to board control of the board from the VC side? Like when you are investing, what you expect, what you want to control, or how much control these VCs are looking for? Could you explain?
In the early stage, probably the founders should still, I mean, very early stage founders should have majority. VCs would want to have a board seat. I mean, we typically only invest if we get a board seat. Okay. It doesn't need to be the chairman, but board seat. Maybe we will help you then find a chairman, independent chairman sometimes as well. You know, the stage that you're in, you should still control the board. That would be my advice. At a later stage, the founders will not be in the majority anymore, which is also fine. That's okay. I mean, ideally, you will get an independent chairman that doesn't represent really the capital, so it doesn't become too one-sided, so that the capital can dictate anything to the founder. But initially, you should keep control of the board.
I guess it answers the question. Selim. Okay. Igor, yes, take another chance.
Any happy accidents or big failures in working with Saudi Arabia? So working with university there, but also entering the industry, and yeah, investment opportunities as sand on the sea. How was it?
Yeah, we have one investment in Saudi Arabia, one company. It's an education tech company. We invested in them, probably not the most unique technology, but we invested in them because it's a big, attractive, and kind of bit closed market for other companies who do something similar. they're doing okay. They're not doing outstanding. They're doing okay. I think, but take it one level up, one abstraction level up. My key learnings also from McKinsey. So it's obviously a very rich market. They're very wealthy. They want to develop. Technology is exciting to the Saudis, and they want to be at the forefront. On the other hand, they're still developing a talent bench. This is why you have, if you go to KAUST University, you have many foreign students because they need to develop it over time. I mean, you don't build technical talent in no time. Decision making is very slow. So you need to live with that. I mean, decisions in Arab countries take forever.
Longer than in Europe.
I mean, my personal bias is the Saudis, Middle East. They're typically more interested in the US than in Europe. It's a bit of a stereotype, but I've experienced that a lot. So I guess it's an attractive market. You need probably somebody local who helps you go through this lengthy decision making and keep the longer term interest of the important stakeholders in Saudi. But then they can be good partners.
All right. Well,
would you say
yes?
Europeans are slower or Chinese?
No,
Saudi.
I mean they obviously get nowadays. I mean, Dubai and Abu Dhabi and Riyadh and Jeddah, they become the new capitals of money, right? There's so much money. There's so much sovereign wealth money. There's so many families, and they become increasingly aware of the power that they have as institutional and private investors, and they get pitched opportunities from all over the world. And we all know, I mean, I assume you're European, that Europe suffers from the fragmentation, etc. So for them, it's easier to imagine how they can be successful in China and the US. I'm not saying it's not possible for Europeans, but they get a lot of opportunities. So that's probably also why they take their time for decision making. And the other thing, another thought, it's a longer discussion, but another thought is typically what is very attractive for Middle East investors and countries is if you bring something back to the country. Okay, so they moved a bit from just distributing money because they wanted to generate some returns. And they're looking more what can you do for the country and to develop their own talent base and technology base, etc. So if you have an element of that, that's typically helpful.
Thank you so much also for being so precise in the comments. And the last question, I guess, from Vitalis.
Yeah, thank you for a session. It was very informative and interesting from all the angles. Unfortunately, we don't have a lot of time to discuss all the details. Another question I had regarding the funding stages. You mentioned that there are some KPIs, and obviously, if you have some investing on later stages, you have pretty good terms. But do you have also some terms and KPIs that founders should kind of do, and what will happen if, I don't know, there is no growth that it's expected to be, or it's lower, or it's bigger? So what is usual approach for, let's say, investments versus metrics, let's say?
Aram, you want to
in
take
1
this?
minute.
Could you maybe repeat the question, because I think it was a bit broad and I didn't maybe catch.
So you got the investments, you have some kind of metrics to fulfill. What is the approach from the VC side if you didn't do so, or you overshoot, you did better? So if you bet, let's say, bad scenario and good scenario, is there any kind of, I don't know, you receive the money, but you didn't fulfill the metrics you needed to fulfill? Is there anything like?
You mean like startup didn't fulfill the
yeah, as a startup.
Again, I never seen actually the startup which reach actually the goal which written in any deck. I mean, like it's a typical question, it's a typical case when you write, I will reach like 2 million ARR in next year, and you reach 1.5. It's not a tragedy. It's like a typical story. It depends maybe on the gap which you have, because sometimes I see the stories when they tell you like we'll reach like 2 million ARR, but they reach 0. It's a tragedy, yes, and. But again, it depending on the gap, yes. I mean, like, again, I never seen that anybody will reach the goals which they proposed. Because again, the whole initial goals super optimistic. And they have nothing with reality. Of course, I divide it by 2, by 3 in my mind. But anyway, it's that's why I don't like actually financials, to be honest, because they are typically some fantasies actually. That's why I'm trying to build my own to understand actually what's more reality.
The reality.
And in reality is like in 2, 3, even like 4 times lower. But anyway, model gives you like some understanding actually how the like revenue or like cost structured, but not like, again, you should model with numbers is nothing. Model with assumptions is a key. But again, back to your question, there's nothing bad. You just should analyze why they didn't reach the goal. Typically, again, they expected that the I don't know, marketing campaign will be shorter. In reality, it was longer. They reached the clients or like sales cycle. They expected that it will be like 6 months. In reality, it was like 18 months and so on. You should understand what is behind this like decrease. If it's quite reasonable, again, reasons, again, guys, let's continue. Maybe you need some breach. Let's negotiate the breach round and so on. But if you see like there is nothing reasonable, like and in reality the product is really bad and they can't find even in other words, it's not an issue of it's not an issue of sales cycle, because like from 6 to 18 there is no sales cycle, because any conversation ends from the beginning, yes, because there is no interest. It's starting to raise some questions, and maybe you should maybe again like not close with deal. You maybe start to finance, because it will be disaster at some point, because you will finance like the deadly project, yes, from the beginning. I mean, you should understand what is the reason. If they didn't reach the goals, but the reason is quite reasonable, okay, there is no tragedy. We go further. But if some big issues, I don't know, some macro issues and so on, maybe you should rethink about like whole investment strategy. Because again, don't forget, VC is not only making the money; it's about also losing the money. And you should be quite in VC. You should be okay to lose money. Of course, not a lot, but some portion of it, it's okay, because how is it structured? You can't make like return to each deal. If you invest in 30 deals, believe me, 10 of them it will be 0. And actually it's okay. It's like nature of the deal.
All right. Sorry to be a party pooper, because yeah,
we see you also in Bremen on the day. Reach out to us if you're there.
Yes, exactly. That's what I was saying. Like demo days also could be a place there. Please, dear startups, give the feedback to the workshop. Just already opened the link. And thank you so much for the speakers. Thank you so much for the attendance until the end. Wishing you everyone a pleasant day ahead, and thank you for some extra time. So yes, thank you.
Thank you.
Bye-bye. Have a nice day.
Bye-bye.
Thank you.